Welcome to the Score Podcast.
According to VantageScore's credit gauge tool, which as listeners you know is our monthly credit health report, delinquencies are on the rise. But yet on the whole, consumers are relatively healthy, and more consumers have shifted out of subprime than in. So how can both things be true? Stick around and we'll find out how. I'm Jeff Richardson, host of the Score Podcast, where we always speak to the most innovative and informed leaders in the marketplace. There's been a fair amount of press attention on how consumers' credit health improved during the pandemic and how that's reflected in their credit scores. Due to stimulus payments, limited reporting of delinquencies because of forbearances, and just the fact that we couldn't spend like we normally would since travel and entertainment options were limited, consumers paid down their debt and kept utilization rates low, hence the increase in scores. That was then, and this is now. So what's happening when you peel back the onion on credit scores? Joining me today is my colleague, Dr. Rikard Bandebo, who, as EVP and Chief Product Officer, is responsible for the company's product portfolio and the development of VantageScore's new credit scoring models. Rikard has more than 20 years of experience in quantitative and qualitative data analysis and product strategy leadership. He previously served as Chief Product Officer for Deloitte's Burson unit and was also the Chief Economist for First Data, which was, of course, later acquired by Fiserv. We don't have nearly enough time to run through his full background and qualifications, but needless to say, he's seen a few credit cycles during his career. Rikard, thanks for joining the podcast today.
Thanks,
All
Jeff.
right, let's start here. How are consumers handling their credit? What's the latest from Credit Gauge?
So we are seeing that delinquency rates are continuing to rise year over year. We actually saw that across all the different days past due categories. They're up from a year ago in June. We also saw this month of June that the month-over-month increases in early stage delinquencies went up from about 0.71 to 0.82. So that's an increase that's pretty substantial. We're not seeing the same upticks yet in 60 to 90 days and 90 plus days, but obviously 30 to 60 days is a leading indicator of those categories. If we look around sort of specific products, we see that auto loan, credit card, and personal loan delinquencies are actually now in a position where they're near or above pre-pandemic highs. So that those are clear categories where lenders are, keeping a close eye on how those are developing. But on the good news side, I think we're seeing that there is a rebound this month in new loan originations. So after seeing a decrease in May, we're now seeing a bit of a rebound in June across pretty much all credit products and tiers. So month over month, we see that personal loan increased, so did credit card, auto loan, and mortgage. So despite this increase now in June, they still though remain sort of below the levels they were a year ago. And that's just a sign of the continued I think tightening that we're seeing, that consumers having a little bit harder time to be able to do spending, and that lenders are also becoming a bit more cautious before offering these products than they were before.
Right. Those are some interesting trends that seem to be working against one another, but are actually quite related. So let's talk a little bit now about some of the recent media attention on credit scores. What can you say about some of the concerns expressed around score migrations and rising default levels?
So I think, as you were pointing out before, we had an unprecedented period during the period where the pandemic was in full effect. So as you pointed out, there were a lot of stimulus that was in the economy. So people had more money to spend. They actually had less things to spend it on. So we actually saw that people were, they were increasing their savings, they were paying down their loans. And then also there was just a long period where a lot of products, they weren't reporting any delinquencies, from student loans to different types of housing obligations that people have. So, that created then, a period of 1 to 2 years where consumers' credit files were becoming very, very healthy as a result of that. With that, therefore, we saw that the credit scores increased. But it's pretty clear that we're now at a turning point, and lenders really need to be very thoughtful about that criteria and really try to monitor the changes in consumers' financial circumstances and really look closely at the delinquency rates for the different types of products and different score bands to make sure that they can keep ahead of that and adjust their lending policies as a result. But also interestingly, we saw, for instance, that the Synchrony CFO recently talk about how they are also seeing that people's disposable income is getting stretched, and that they've seen that several of those consumers who during the period of the COVID saw a big increase in their scores, they're now seeing, several of those coming down pretty significantly as well. So definitely then we're at a turning point, and that's something that lenders need to be very closely monitoring.
Well, that's a perfect segue, because I wanted to maybe just dig a little deeper into kind of the lender perspective. So when they're looking at their portfolios and some of these trends are happening in real time, what are they looking for?
So the thing to just keep in mind is that credit scores don't have a fixed relationship with risk, right? So the risk for a given score is changing, it's going up and down. So what lenders need to be really, really thoughtful of is understanding how those trends are going up and down. Some of them call this chasing the odds, but the whole notion is trying to understand how these scores are performing with new products or even with existing accounts, and how the delinquency rates are changing by people falling into these different score bands. That's a critical form of analysis that lenders do. And in fact, we invested quite significantly to put out now our available tool Risk Ratio, which enables lenders to easily access that information, whether they look at it in charts and be able to understand it visually, or if they want to download the raw data. But being able to have access to that is obviously, very important as they're going through this. And so we're very glad that we can now provide that service and really help lenders in that side of things. The other thing looking at that is understanding, well, what is it that's causing these delinquency rates, for these different score bands to change? And that is, the different macroeconomic factors, the things that aren't included in score models, because, scoring models are meant to focus on an individual, not so much, the broader economy. So, for lenders, it's really important for them to truly understand sort of how these different macroeconomic factors that impact delinquency rates, how they're trending and where they're going, such as unemployment, job openings, housing costs, interest rates, etc. So all of those things will give them a sense of where things are going, and then obviously they will need to make their own interpretations of where they think that what that's going to mean for the next 3 months, 6 months, a year, etc.
So lenders, which I know you're listening, Risk Ratio is available on our website at VantageScore.com. It's free to use, and it helps monitor performance of originations or active accounts by products. And you can compare vintages going back all the way to more high-risk timeframes like the Great Recession. So, Rikard, let's close with a question about student loans, which has also been a hot topic in the media. As we know, the Supreme Court struck down the Biden administration's debt relief program. And prior to that, because of the debt ceiling agreement, student loan borrowers will be expected to begin making payments on their student loans. So your team has released some data on the impact of credit scores, and we've covered that before on the podcast. What I want to ask you is, how will this impact interplay with the broader impact to default rates and kind of how scores will be migrating?
Well, so the first thing I'll say is that this is a really big deal. It is an enormous amount of money that this is $1.3 trillion in student loans that, the 40 million Americans who owe that money have not been having to pay for now, going back to early 2020. So now that will restart, that is a significant expenditure every month that people have, gotten used to not having to cover. And as we're already seeing in the economy, we're seeing a large number of consumers already sort of struggling potentially with their existing cash flows and relying on personal loans and increasing the utilization of their credit cards to cover that. And if a large portion of that population is also now going to have to start paying off their student loans, that's going to put, a substantial part of the US under even more pressure. So it's a really, really big potential downweight on the economy that, everybody should be watching very carefully. Now, in terms of the thing that's really important to understand, there's also the timelines. So, with the agreement on funding the government, they landed on obviously restarting payments. And the timeline for that has been clarified now, but it may well change. But as far as we see that it is now, the first payments are due on October 31st of this year. And that's also when interest rates will begin accruing, and you'll begin seeing those interest rates impacting the amounts on the credit file starting already now in November. But because they're trying to smooth the impact of this change, we're seeing that the Department of Education is not going to have any adverse reporting until September of next year, September 2024. So that really means that the first delinquencies are not really going to appear on the credit files until December of 2024. So there's quite a bit of time between now and when we'll start seeing the real impact of this. What we also see, though, is obviously with the recent ruling from the Supreme Court, it is the vast majority of these lenders that are going to need to start repaying. So there are programs in place, but again, those will be affecting a minority. And so we'll expect most people then, having to, make ends meet, try to reduce spending, or maybe they're going to have to reduce their repayments or even default on other financial products. So it'll be difficult to see what that impact is going to be. I think one thing that lenders are going to be monitoring closely is, how do they prioritize these student loan repayments over other types of financial obligations they have. Now, in terms of your question around sort of what impact will this have on scores, we looked at a number of different scenarios, and I maybe touched on this before, but I'll just reiterate some of the key points. So we looked at what was the behavior of people with student loans prior to the forbearance coming in place in 2020, as well as what have they been doing, how has their behavior been on other credit products during the period since the forbearance, as well as how many consumers are of this population, if they have been repaying some of their student debt, even though there's not been an obligation for them to do so. And when we looked at those different scenarios and looked at how people are likely to repay based on these past indicators, we see that on an optimistic side, and maybe 34% or so that could be challenged with making these payments, and on the upper side, it could be as much as 76% that will be challenged and potentially miss some of their first payments. So that's important because those who miss these payments can see their scores going down between 49 and 82 points. So that will really have a significant knock-on effect on, if they want to go get a mortgage, the pricing will be different or may even disqualify them from certain types of mortgages. And obviously it'll have impact on other financial products as well. Obviously, those that do resume paying will see a positive impact of that. So they can expect to see their points going up, anywhere up to 8 points. But all in all, we think that this is going to have a downward pressure on credit scores as a whole, and we could see the average credit scores going down somewhere between 1 to 9 points.
Wow. So I suspect many are going to be toggling back and listening to that answer over again and take copious notes because there was a lot of nuggets in there. Rikard, terrific insights. Thank you for joining the podcast, and we need to get you on more often. Thanks again.
Thank you, Jeff. I enjoyed it.
It's maybe the least understood aspect of credit scoring. A 700 score today will represent a totally different risk during the next credit cycle. As macroeconomic issues change, so does the risk that any score represents. Not understanding this can be costly. A lender might see some surprise defaults or even leave new loan originations on the table because their minimum credit score requirements are actually too low. That's exactly why we've introduced Risk Ratio. The tool is totally free and introduces unprecedented transparency for lenders. I'm Jeff Richardson, and I look forward to our next conversation.
The views and opinions expressed in this episode do not necessarily reflect the official policy or position of VantageScore Solutions. Visit VantageScore.com to learn more.